Question 806. Frank is a plumber who completes a copper repiping job on Noel's house. Noel refuses to pay for the work. Frank should A. File a mechanic's lien. B. Seek a sheriff's sale. C. Record a foreclosure action. D. Report Noel to the police. Correct answer is A. File a mechanic's lien. A mechanic's lien, often called a construction lien or contractor's lien, is a legal claim against real property for the value of labor, services, or materials furnished for the improvement of that property. If Frank properly files a mechanic's lien, it places an encumbrance on Noel's house, making it difficult for Noel to sell or refinance until the debt is paid. This provides security for Frank's payment. In California, there are specific steps and strict timelines, like preliminary notices, that must be followed to establish a valid mechanic's lien. Filing the mechanic's lien would be the first step for Frank to take. A sheriff's sale is the public auction of a property to satisfy a judgment or lien. This is a later step in the enforcement process, typically after a mechanic's lien has been filed and a lawsuit to foreclose on that lien has been successful in court, resulting in a judgment. Frank cannot directly seek a sheriff's sale without first establishing his claim. A foreclosure action is a lawsuit to enforce a lien, like a mechanic's lien or a mortgage. If Frank isn't paid, his ultimate goal might be to foreclose on the property. However, the crucial first step after non-payment is to file the mechanic's lien. This recorded lien then paves the way for a foreclosure action if the debt remains unpaid. You record the lien, then file a lawsuit to foreclose on it. Refusing to pay for contracted work is generally a civil matter, a breach of contract, not a criminal matter. The police typically do not get involved in civil payment disputes unless there's evidence of criminal fraud, which isn't indicated here. Question 807. Which of the following is not an example of the police power? A. Zoning ordinances. B. Building codes. C. Condemnation. D. Subdivision regulations. Correct answer is C. Condemnation. Police power is the inherent right of the government to regulate private property and individuals for the protection of public health, safety, morals, and general welfare. It does not require compensation to the property owner, unless the regulation goes so far as to constitute a regulatory taking. Zoning ordinances are regulations that dictate how land can be used, e.g., residential, commercial, industrial, and establish rules for development. This is a classic example of police power, as it promotes public welfare by ensuring orderly development and separating incompatible land uses. Building codes are standards for the design, construction, alteration, and maintenance of buildings, enacted to ensure the safety and health of occupants. These are clear exercises of police power. Subdivision regulations are rules that govern the division of a parcel of land into smaller lots for development. They often address street design, utilities, open spaces, and lot sizes to ensure proper infrastructure and public safety. That's making them an exercise of police power. Condemnation is the process by which the government exercises its right of eminent domain. Eminent domain is the government's power to take private property for public use, even if the owner doesn't want to sell, provided just compensation is paid. This is distinct from police power, which regulates property use without taking ownership and generally without compensation, unless it's a regulatory taking. Question 808. If a trust deed is foreclosed upon through the process of judicial foreclosure, then A. There is a legally specified deadline imposed on the foreclosure sale to occur. B. The trustee must file a default notice to the borrower. C. It follows the same procedure as a trustee's sale. D. None of the above. Correct answer is D. None of the above. Answers A, B, and C all apply to the other kind of foreclosure action, the trustee's sale. The borrower has the protection of a 1-year redemption period. This is the correct and most significant characteristic of judicial foreclosure in California. When a lender pursues a judicial foreclosure, a key protection for the borrower is the right of redemption, also known as the statutory right of redemption. In California, a borrower typically has a one-year right of redemption after a judicial foreclosure sale if a deficiency judgment is possible. However, this period shortens to 3 months if the sale proceeds fully cover the judgment. This allows the borrower to reclaim their property by paying the sale price plus specific costs. This right of redemption does not exist in a non-judicial, trustees, sale. Question 809. Farmer Brown's orchard was taken away in order to build a freeway. This is done in accordance with A. Eminent domain, B. Police power, C. Dedication, D. Easements. Correct answer is A. Eminent domain. The police power refers to the government's inherent authority to enact laws to protect public health, safety, and welfare. Examples include zoning laws, building codes, and environmental regulations. While this power can sometimes result in restrictions on property rights, it doesn't involve taking property for public use. Dedication is the voluntary transfer of private property to the government for public use. In this case, Farmer Brown did not voluntarily give up his orchard. An easement is a legal right that allows someone to use another person's land for a specific, limited purpose, e.g., a utility company having the right to run power lines across a property. It does not involve the government taking full ownership of the property, though easements can sometimes be acquired through eminent domain. Eminent domain is the government's power to take private property for public use, provided that just compensation is paid to the property owner. Building freeways, schools, and other public infrastructure are common examples of eminent domain. The process of taking the property is called condemnation. In this case, the government took Farmer Brown's orchard to build a freeway, which is considered a public use. Therefore, the government's action in taking Farmer Brown's orchard falls under the power of eminent domain. Question 810. If a lender accepts a deed in lieu of foreclosure, the borrower is still liable for A. Junior liens, B. Mechanic's lien, C. Judgments, D. All of the above. Correct answer is D. All of the above. When a lender accepts a deed in lieu of foreclosure, DIL, the borrower voluntarily transfers the deed to the property to the lender to avoid the formal foreclosure process. While a DIL can release the borrower from the primary mortgage debt owed to the lender who accepts the deed, it does not automatically clear all other debts or liens on the property. The DIL generally aims to release the borrower from the debt secured by the mortgage that the lender holds. The DIL generally aims to release the borrower from the debt secured by the mortgage that the lender holds. However, for a complete release, the DIL agreement must explicitly state that the transaction fully satisfies the debt. If the agreement doesn't contain this provision, the lender might still be able to pursue a deficiency judgment for any difference between the property's value and the debt. In California, anti-deficiency laws may offer protection, but it's crucial to have the release explicitly in writing. Junior liens, e.g., second mortgages, mechanic's liens, judgment liens, is the critical point. Unlike a foreclosure sale, judicial or non-judicial, which can wipe out or extinguish junior liens, a deed in lieu of foreclosure typically does not extinguish junior liens. When the lender accepts the deed, they take ownership of the property subject to any existing junior liens. If there are other mortgages, junior liens, mechanic's liens, or any other liens recorded against the property, the borrower generally remains liable for those. The new owner, the lender who accepted the DIL, will then take title to the property with those liens still attached. This is why lenders often prefer a formal foreclosure, as it provides a cleaner title. Similar to other junior liens, a recorded judgment against the borrower's property would create a lien. A deed in lieu of foreclosure would not automatically eliminate this judgment lien against the property or the borrower's personal liability for the judgment unless the judgment creditor agrees. Therefore, if a lender accepts a deed in lieu of foreclosure, the borrower is generally still liable for all of the above, junior liens, mechanics liens, and judgments, unless specific agreements are made with each of those lien holders for release. The borrower is generally still liable for all of the above, junior liens, mechanics liens, and judgments, unless specific agreements are made with each of those lien holders for release. The DIL primarily addresses the debt owed to the lender accepting the deed. Question 811. A real estate license applicant whose name is on the state's list for delinquent child support can A. Receive a temporary 150-day license, B. Receive a temporary 1-month license, C. Receive a license at the discretion of the real estate commissioner, D. Never receive a license, their non-payment disqualifies them in perpetuity. Correct answer is A. Receive a temporary 150-day license. In California, if a real estate license applicant's name appears on the state's list for delinquent child support, they are not immediately disqualified permanently. Instead, the Department of Real Estate, DRE, will issue a temporary 150-day license to an otherwise qualified applicant. During this 150-day period, the applicant must work with the Department of Child Support Services, DCSS, to get a release. If a release is not provided to the DRE within those 150 days, the full-term license will not be issued, or an existing license will be suspended. Question 812. An escrow agent is empowered to A. Alter the escrow terms when asked to do so by one of the parties, B. Determine which financing offers the best terms to the buyer, C. Select which security system to be installed at the property, D. Call for the loan to be funded by the purchaser. Correct answer is D. Call for the loan to be funded by the purchaser. An escrow agent acts as a neutral third party in a real estate transaction. Their primary role is to ensure that all conditions of the purchase agreement and escrow instructions are met before the transfer of funds and title occurs. They operate strictly according to the written instructions provided by the buyer and seller. One of the critical roles of the escrow agent is to manage the flow of funds and documents. When all closing conditions are met, the escrow officer will request the necessary funds. This call for funds goes to the buyer's lender for the loan amount, and directly to the buyer for their down payment and closing costs. This ensures all money is in the escrow account for the final disbursements. They facilitate the funding process according to the instructions. An escrow agent is a neutral party and cannot unilaterally alter the escrow instructions or terms of the contract. All parties involved, the buyer, seller, and sometimes the lender, must agree to any changes in escrow terms. These revisions must then be given to the escrow holder in writing. This written document acts as an amendment to the initial instructions. That is the role of mortgage brokers, lenders, and real estate agents, for general advice, or attorneys, for legal advice. The escrow agent's job is to follow the instructions regarding the financing that the buyer has already secured. Decisions about property improvements or fixtures are made by the buyer, possibly with advice from their real estate agent or inspector, but not by the neutral escrow agent. Question 813. A joint tenant is legally able to A. Lease their interest, B. Sell their interest, C. Encumber their interest as security for a mortgage loan, D. All of the above. Correct answer is D. All of the above. A defining characteristic of joint tenancy is the 4 unities: time, title, interest, and possession, and the right of survivorship. This right means that upon the death of one joint tenant, their interest automatically passes to the surviving joint tenants, bypassing probate. However, a joint tenant can take actions during their lifetime that can sever the joint tenancy and convert it into a tenancy in common, which does not have the right of survivorship. A joint tenant can lease their interest in the property. However, a lease generally does not sever the joint tenancy in California. The leasehold interest would terminate upon the death of the lesser joint tenant, and the surviving joint tenants would take the entire property unencumbered by the lease. A joint tenant can sell their interest in the property without the consent of the other joint tenants. If a joint tenant sells their interest to a third party, it severs the joint tenancy as to that selling tenant. The new owner becomes a tenant in common with the remaining joint tenants, who continue to hold their interests as joint tenants with each other. A joint tenant can encumber their interest, e.g., place a mortgage or deed of trust, on their share of the property. In California, a mortgage or deed of trust placed by one joint tenant does not sever the joint tenancy unless and until the mortgage is foreclosed upon and the property is sold during the lifetime of the debtor joint tenant. If the debtor joint tenant dies before the foreclosure sale, the lien typically extinguishes because their interest automatically passes to the surviving joint tenants, free of that lien. Since a joint tenant can sell, lease, and encumber their interest, even though the effect on the joint tenancy varies, selling severs, leasing and encumbering typically do not unless a foreclosure sale occurs. All of these actions are legally permissible for an individual joint tenant. Question 814. Junior loans are usually secured from A. Insurance companies, B. Private lenders, C. FHA, D. Commercial banks. Correct answer is B. Private lenders. Junior loans, or second mortgages, third mortgages, etc., carry a higher risk for lenders because in the event of a foreclosure, they are paid only after the senior, first loan is fully satisfied. Due to this increased risk, junior loans are often obtained from sources willing to take on that risk, typically at higher interest rates. Insurance companies are major players in the mortgage market, primarily investing in large, stable, and less risky ventures. They often focus on commercial real estate or act as investors in first lien mortgage-backed securities. They are less common direct originators of higher-risk junior residential loans. The Federal Housing Administration, FHA, insures primary mortgages, first liens, to make homeownership more accessible, especially for low to moderate income borrowers. They typically do not originate or insure standalone junior liens like private lenders. However, FHA loans can sometimes be paired with down payment assistance programs, often structured as junior liens, from state or local agencies such as CalFA in California. Commercial banks certainly originate mortgages, including home equity loans and lines of credit, HELOCs, which are junior liens. However, they typically have stricter underwriting standards than private lenders. They are often less willing to take on the higher risks associated with many junior loans, especially those lacking substantial equity or strong borrower credit. Private lenders, including individuals, mortgage funds, and hard money lenders, are a very common source for junior loans. They are more flexible, can often close deals quickly, and are willing to take on higher risk in exchange for higher interest rates and fees. Many junior loans, especially those for short-term financing or for borrowers who don't qualify for traditional loans, come from this sector. Seller financing can also be a form of private junior lending. Given the common characteristics of junior loans, higher risk, often higher interest rates, more flexible terms, private lenders are a very significant source. Question 815. Private restrictions imposed on property can be conveyed by A. Contract, B. Deed, C. General plan descriptions, D. All of the above. Correct answer is D. All of the above. Private restrictions, like CC&Rs covenants, conditions, and restrictions, are indeed limitations on property use established by private parties. The fundamental agreement that creates these restrictions is a contract. Developers enter into contracts when planning and selling properties in a subdivision, and these contracts often include the terms of the restrictions. Subsequent buyers implicitly or explicitly agree to these by purchasing within the restricted community. Deed is a primary method. The individual deeds for lots within a subdivision will either contain the full text of the restrictions or, more commonly, reference a previously recorded master document, like a declaration of restrictions. By accepting the deed, the grantee, buyer, becomes bound by these restrictions. In the context of a new subdivision, the developer records a comprehensive document, often titled a Declaration of Covenants, Conditions, and Restrictions, sometimes referred to as part of the general plan restrictions, in the context of the entire subdivision development scheme. This master document is recorded in the public records and sets out all the rules for the entire subdivision. Even though it's a private document, not a government, general plan, it functions as a foundational set of restrictions that applies to all lots. When individual lots are then sold, their deeds will reference this recorded declaration.